Okay, let's repeat it all over again. So we're going to talk about domicile, residency, wages allocation, party resident, non-resident, and apportionment of income. Very important to note. When we're talking about multi-state, okay, there are things that are being allocated and there are things that are being apportioned. What is the difference between allocation and apportionment? Allocation is you taking whole, pretty much, type of earnings and allocating it to that particular state. The example would be the person worked in New York for 30 days. For 30 days, they were paid by a company. So the W-2 from that company would be allocated to New York, okay? Apportionment is done for entities that are other than disregarded, meaning C corporations, S corporations, partnerships, and trusts. And it is based on mostly three-factor allocations. Sometimes you can get away with one-factor allocation. In fact, in the past probably 15 years, one-factor apportionment, is accepted if unless the person is a farmer or other type of agriculture or other business is engaged in farming or agriculture. So a lot of times you could use, provided the state does not have legislature preventing you from doing so, you could use one-factor apportionment, okay? So apportionment of income is for businesses, allocation is for individuals, okay? All right, so why did I open this guy? Well, because this is an interesting case of Benjamin Buttons. Why is it interesting? Because this fella actually went ahead and received a letter from Mr. IRS. Not from Mr. IRS, pardon me, from New York. From New York, he received original assessment letter. What does the letter say? Well, the letter quite literally says that he owes quite a bit of money because New York wants full amount, okay, full amount of adjusted gross income to be in fact taxed for New York purposes. Now, when we look at what has actually happened this 2021 tax year with the client is that, well, they actually did not live in New York for longer than 180 days. And this is where first we decide, well, are they a resident, or non-resident, or a party or resident? Well, in order to be party or resident, they would actually need to have had established a residency in New York, okay? So not only they're definitely, the residency, they did not establish residency. So not only they're not full year resident, obviously, because they lived in New York for only 2 months, they're also not a party or resident, okay? In order to be party or resident, 180-day rule must be met. The only caveat to that could be, and maybe this is what Mr. New York implying, is that you would have to have established, oh my goodness, the tenses are killing me this morning. But you would have to have had established domicile in New York. Now, what is a domicile? Well, domicile, it's when you move from one state to another with intent to stay, and you have had enough time to get a brand new driver's license, establishing residency, you have signed a long-term lease of sorts for an apartment or house. Pretty much you intend to live in that state moving forward, okay? So In this case, did New York become domicile? Yes. Okay. Yes, it did. However, even if New York became domicile, we still need to discuss the residency. As we know, there is that 180-day rule in order to be part year resident, okay, or established residency. Part year residence simply means that you had, let's say, 2 or 3 residences, which is probably 2, 180 plus 180, that's 360. So you can have 2 residences, and if it is, in fact, in one place you lived 180 days, in another 180, then you're part-time resident in one spot, part-time resident in the other. Or you could interpret if the person has had enough time, which they would have, to establish domicile in the last state that they moved in, that they're part-year resident in the first state where they moved out of, and they're actual resident at that point in the state that they moved into. However, here, personally, I would argue, based on the facts that we have, is that Kevin and Naren have only been in New York for 2 months, okay? They are definitely non-residents because they have not met the requirement of 180 days to establish residency. However, this state is their domicile state now. What does it mean? Well, it means that there could be 2 ways to interpret what New York is suggesting. First, we can argue with them. Quite literally, we would argue that because Kevin and Naren have been in the state for only 60 days, they are non-residents. Therefore, the only income that is going to be taxable to New York is going to be income actually made in New York. But this is where the domicile comes in. Because, in fact, New York is now their domicile, and we know that because they still live in New York, all of the passive activity would also be taxed to New York. What does passive activity mean? It means interest, retirement, brokerage transactions, for sale of stock. So capital gains, literally speaking. So all of these things would also be then attributed, aka allocated to New York to be taxed, okay? So we could take that route. But seeing as how New York is not a very agreeable state, and most likely they will come back simply saying that the adjustments already have been made, pay the balance due, they're going to keep harassing the client, we can take a different approach. In this letter, New York stipulates that, in fact, they do want to attribute full amount of income from federal tax return to New York. What does that tell us? Well, that tells us that we need to look into area of tax law where not a single taxpayer should pay double tax on the income while made in different states, okay, while that income was made in different states. So what we're going to be showing here to Mr. New York is that, in fact, Kevin and Naren have paid an empty amount of taxes to District of Columbia, okay? To District of Columbia, they ended up paying $5,515. They have prepaid $67.27. They did get a refund of $12.12. So by that logic, what we're going to do is, when amending New York tax return, instead of arguing with New York the fact that the income really doesn't belong, and New York, please make an adjustment, which we could, as I mentioned before, there's 2 approaches, right? But I just feel like it's going to be very time consuming, and at the end of it, New York still may continue issuing the notices and not being agreeable, okay? So to avoid headache for the client, what we're going to show is that, oh, wait a minute, if you want to say that there was indeed, that if indeed the whole dollar amount, let's say, of wages and capital gains and losses are attributed to DC, well, then what we're going to do, we're going to take a credit, okay? Now, what will the credit equal? Well, we're going to look at DC quite literally, reconstruct what DC tax return says, what the taxpayers have been taxed on, okay? And we're going to tell how much they have actually prepaid. Sorry about that, guys. I must just come in. All right. So where would we go to show it? We are going to go into state and local. Then we're going to go into other state tax credit. You would always choose the state to which you want to give the credit to, right? So in our case, New York needs to accept how much was paid to DC. And then we would elect, well, this is the state abbreviation, okay, DC. We would show how much of wages DC has taxed. We would show how much of capital gains DC has taxed. And if indeed Erin and Kevin would be a resident, okay, a resident of New York, the program would have calculated it on its own. All you would have to do is select DC, okay? But since they're not residents, the system will not calculate it for you guys, okay? It simply will not. So two ways. You can either override the residency in the general, right, where it's client information. Here, a resident state, well, it says New York, multi-state, but in our example, because of short amount of days, and this is technically where I have a little bit of a beef with this question, because did they reside there? Yes. Have they established residency as of 12/31? No. So then it should really say domicile, okay? But let's roll with it. For the purposes of this software, let's roll with it. So, okay, they were 12/31, New York, multi-state, but full year resident was not marked, okay? Since it's not marked, system is not going to calculate for you. So we're going to go back into New York. Yet again, you would select here the credit to which state you want to give the credit to, okay? From which state we are given the credit. You would fill out exactly as it appears in this state that you've selected tax return. And then you would see tax paid by the taxpayer. Now, this is very important. So tax paid by the taxpayer. When we go into actual forms, we're not going to be looking at how much was prepaid, okay? So you're always going to have lines within the state that tell you what is the actual tax, okay? So here in DC, for example, line 20 tax. Now, this line is going to be, doesn't matter what number it is, but every single state has a line that says tax. So total tax liability, 5515, okay? And this is the number that we're going to be using, not how much they've prepaid, okay? Because they are getting that money refunded. So what actually DC left for themselves to have, okay? And that is 5,515. So then we're going to go ahead and check to make sure that we've done everything correctly. Wonderful. We are given $5,515 credit. On that amount, New York State tax payable is $6,808, okay? Less what, or you would rather compare, okay? What is higher, the New York payable or the DC? And since New York is higher by the system calculating it, Okay, you don't need to do that manually. We are able to take $5,515 credit. So now, when we go into the amended New York state tax return, we are going to see that New York State taxable income 117,785. So it is a little bit higher, and it is due to the cryptocurrency not being reported on the original return. Okay, so our taxable income is consistent with what New York would have proposed had they known that the cryptocurrency was in play. Okay, from that, potential New York state tax is 6806, and it is consistent with what we saw on the credit form. From there, we are going to show the credit. Okay, we are going to show the credit 5515. So total New York State taxes where the liability shows up is 1387. There could be various, which is over here, for example, New York City and Yang part here. Okay, so what we can do is we can also fill in because they did live in New York City. Bear with me. Okay. And okay. This should bear with me for a moment. Okay, so in certain cases, because we're overriding things, we're just gonna have to write it a little bit more. Bear with me for one moment. So there was only one W-2. And I don't recall if it was from, there we go. Okay. And then Aaron probably is the one coming here. Okay. Also, one point to note, W-2s in some cases will contain 2 pages, okay? Sometimes even more. This one has all kinds of different things on it, that's fine. But I would suggest checking and making sure that you have captured all of the state wages, okay? Because the system will not know, and you need to make sure you just double check that you have all the correct entries. Nope, it doesn't want to cooperate with me, but no matter, I'll figure it out behind the screen, guys, but for the purposes for now, okay, let's move on. So there's going to be a little bit of part year New York City resident tax. Well, let's actually figure it out now. There we go. So ours turned up to be a little bit higher, and all that you do, I just didn't want to fill it out all the way. All that you do is you show, and you don't even need that. We can kill this. All that you do is you show how long was the person resident for. County, while non-resident, you can put a state, okay, because these taxpayers were out of state. Number of full months in residence period. Now, this is not specifically for the purposes of them being resident or not resident. This is simply asking how long have they lived, okay, in that state. So for 2 months, and then you would do the allocation percentage. The percentage would be whatever months you've put in here divided by 12 times 100 to arrive at the percentage instead of a decimal, okay? And so now we do show a little bit of part year New York City resident tax, 604, that's fine. We combine the two, 1387 and 604, we arrive at 1991. They do get a little bit of a credit from New York City because they're paying in taxes to New York City. They have also withheld taxes for New York State and New York City, okay? And so total payments and refundable credits. And they, of course, paid $2,564 with the original return. So total payments and refundable credits is $4,143, okay, less what they owe now. We get ourselves $2,152 back, okay, for the clients. What kind of questions you guys have for specifically individuals, you know, with multi-state apportionment, allocation, anything like that?
No questions for.
Max, do you have any questions?
No, this was great. Really appreciate you doing this.
Sure.
Good choice.
Now, one thing that I feel like is worth mentioning, and I feel like we don't see it all that often with our clients, there are states that have a reciprocity agreements. What does that mean? It means that the taxpayer lives in one state and they're a resident of that state, but they live in a but they work in a different state, okay? So if we go and ask Mr. Google, what states have reciprocity? So very, very easy. I mean, there's so many resources that you guys can find, but some of these articles, they will even explain, okay? They just will reiterate what it is. Well, what it is it eliminates for the person to have to file taxes in 2 states, because by the logic, right, you would pay taxes in the state that you work in. But certain states, because there are so many of these workers that literally live on the border of certain states, and there's just so many more job opportunities in different states, that if they live in one state, they fill out a reciprocity paperwork with their employer. So when they get their W-2, they don't even have to file the tax return with the state that they actually work in, okay? To avoid filing tax returns to the two states and then paying taxes to one state and taking that tax as a credit on another state tax return, okay? So if you see something like in the emails, the person is saying, well, I live in this state, you know, but I commute every day to work to a different state. The first step should be is to figure out whether that state has a reciprocity, okay, with the other states and what those states are. For example, the person lives in Arizona, okay, and they drive to work to California every single day. So you will see that Arizona has state tax reciprocity agreements with California, Indiana, Oregon, and Virginia. So by this logic, if the person lives in Arizona, okay, they can file a reciprocity agreement with the employer, and the employer who's located in California would be withholding taxes for Arizona and not California. Therefore, the person living in Arizona, working in California, would not have to file California tax return. They would strictly directly go to file an Arizona tax return where they're resident and domiciled at, despite them commuting to work to California on a daily basis. Okay?
Can you put this link in the chat?
Yeah.
Please? Thank you.
Oops, I sent it to the wrong person.
I had a client last year, last year, that lived in PA and commuted to New York. And I wish New York had something set up.
Okay, guys, sorry about that. I did send you a link to our tax stuff training, okay? So it's gonna pop up there. Because once we finish the session, this chat's gonna disappear. That way you can, you know, from the WhatsApp, you can copy it and keep for your records. All right, so that is concerning a residency, you know, reciprocity and allocations. Now, one thing I will say, whenever you guys are amending, and this is, I guess, piggybacking on the general, you know, amendment training for the tax returns, whenever the amendments happen, what I would definitely make sure and double check every single time is, did you actually put description as to why you're amending tax return? So I just usually, you know, search. We have made sure that here is everything correct. Explanation of changes. So this is the federal explanation of changes, but okay. We have New York here. This is, by the way, if certain things need to be overwritten simply because the person made voluntary contributions, you know, on the original return or something along the lines, that's where you would actually do that. Okay, this is where you would also say how much the person has paid with the original return. Reasons, certain states, okay, they require for a reason to be filled out, okay? We're gonna, let's say, click wages. But states like California, they will not allow you to electronically file unless you specify the reason. And then where it's, let's say, other reason, you can also actually type in explanation besides the federal one. Okay. To make sure that we have everything in New York that we need, so if you ask me, this line, honestly speaking, is rarely filled out. Sometimes the client may ask you, well, how come, there is no list of federal changes? This is not mandatory. Okay, so you can either try to fill it out, override it, find it within the amendment, which you want to be carried forward here. But honestly, I wouldn't really lose my sleep over it. Okay, we are providing New York everything that they need to know. We have our statements, we have the worksheets. What we also should do, and this is what's going to be done within this tax return, when we go into electronic filing, here it says e-file PDF miscellaneous. Okay, we're going to go all the way over here, e-file attachment. Okay, it's going to be a PDF attachment. We're going to go to Dropbox. We're going to search for Erin, and we must close this. And this is what we're going to attach. So we're going to attach the original assessment. So New York further knows, well, other, and we're going to send PDF attachment with New York. Okay. Then we can get a little bit more specific. Why are we sending it? Well, none of these actually apply. We're going to leave it blank. Okay. So we're just going to send this as an attachment. All right. We're not going to send it with the federal tax return, but we're going to send PDF attachment with New York. Now, whichever tax return you want to send this attachment with, that's how you'd mark it. You can add multiple attachments. Okay. So for example, if we were to be amending federal return for these clients as well, at that point, they had a crypto trading for Robinhood. So a Robinhood statement for the crypto, the 1099-B that they got, would be actually attached to federal, but then we don't need to attach it to New York because to Mr. New York, federal tax copy of the federal tax return when transmitted is attached already in full, okay, electronically. That's just the way it goes. For New York, California, and there's about, I don't know, maybe 15 more states that require actual complete copy of the federal tax return to be attached. Okay, so we're going to delete the blank. We're going to leave the one that we have here. All right, guys, any questions on this?
Nope.
Not for me.
So
No.
now, now let's chat a little bit, shift gears and let's chat about S corporations. Megan, do you have any S corp that pops into your mind, the one you want to chat about, use it as a guinea pig or example?
No, the one I have ended up being like a 200 email long thread, so we don't want to do that. It was a major problem client, but yeah,
Okay.
I can't think of anything else off the top of my head. You definitely don't want to look at that.
Okay, so there's some kind of Attic Pros, whatever, let's choose that one. By the way, and I know this is not for Megan, but just for the newbies, for you guys, whenever you want to filter something here, let's wait for this to think a little bit. So you can either search all, or in our instance, okay? And by the way, if you're searching for the client and you're searching and nothing is popping up, make sure that the wrong thing is not selected here. Because if you're going to be searching for an individual, okay, and you have, let's say, partnership selected, and you keep on clicking, for example, Erin Chi, where are you? Erin Chi. Well, she's not a partnership, so she's not going to pop up. So whenever you're searching for whatever you're searching for, just to be on the safe side, select all, okay? That way, you ensure that the tax return is going to pop up. For our purposes, we're going to look at 1120S's, okay? This is S corporations, aka small.
Can I ask the question? Should we change the tax return year in case the client couldn't be found?
Yes, you should also. So, first thing you do, you would go in Monday, okay? You go in Monday and you look at the tax year, okay? This is the first thing you do. You look at the name, you look at the tax year, and then you look at the type. So if you can't find the person in the tax year that's marked here with the type of the tax return that is marked, then in a way we have a problem. That's going to tell you two things. First is either initially, whomever was creating the project was input incorrectly, and then it's incorrect year, okay? The second thing is if the year has been input correctly, then the administration team, the one that's, you know, in the other country, they have input tax return in the wrong year. And at that point, if the tax return is input in the wrong year, if you're in a hurry, you need to prepare them yourself. If you're not in a hurry and you have, 24 hours that you can wait, you immediately send them a request to go ahead and input the tax return. One thing I will also tell you is sometimes they put, for married filing joint individuals, they may put spouse's name, okay? Husbands or wives, so spouse's name instead of the primary taxpayer that's listed on here, which is really odd, and whatever, I guess we're gonna roll with it. So you always check name, tax year, type. You would be searching in the tax year that is marked within the project. Second step, if you didn't find this name, see if the fella or the lady is married, and then respectively search for that person's first and last name. And then if you cannot find it, then that tells you that there is a mistake somewhere. okay, that the mistake was made somewhere. Does that answer your question, Yana? Yana?
Yeah, it's
Yana,
clear. Thank you. It's clear. Thank you.
all right. So we have Attic Pros Inc. It is a 1120S. Well, what is 1120S? It is small corporation, small because it can have only less than 100 shareholders, or rather 100 or less shareholders. None of the shareholders can be foreigners, okay? None of the shareholders can be foreigners, meaning they cannot be persons with the ITIN, they can only be persons with the social security number. And this is actually a good one. We have lots of things going on here. We also have my favorite depreciation that is huge. Okay, so maybe for this one, let's frame it this way. Let's maybe do kind of like Q&A. Megan, do you have any maybe, particular questions or any way you want to guide this?
My question around S corps, I guess, was like, I'm fine with like the data entry with like the balance sheets and P&L, like all that stuff. Could you go over like the adjusting entries? Do you know what I mean? Because like anytime I do it, there's always a critical diagnostic.
Sure. So most of the time, when we get P&L from clients, right? And for the 1120S, you're going to have a few things where actual activity may show up. So first place is actual page 1 of 1120S. Okay, so this is where the main trade or business activity is going to be listed. And this is where probably the first 3 adjustments, or probably 4 adjustments, could be happening. Well, first thing that happens is when we get P&L from the clients, they don't book their own depreciation. Okay, they don't book their own depreciation. So first line item, aka additional expense, is going to be depreciation. So by the logic, this fella, let's say we're showing right now 76,707. Okay, in order to arrive at the original P&L, we would do 76,707 plus 298,183 because this has not been taken. Okay, and then ideally that would match what they had on their own P&L. Now, the other line item would be amortization, and it's going to show up within other deductions. So it's one of those things that usually gets buried here. So you would need to see statements, okay? Again, amortization is an expense. So in order to arrive at the original balance of the, or at the original net from the P&L, we would add it back. Taxes and licenses, okay? Sometimes this is where payroll taxes that the client may have on their P&L may not match, because a lot of times they book payroll taxes as not actual expense, whatever the employer portion was, but how much was remitted to the IRS. And if you look at the payroll reports, let's say, 941s and 940, the remittance happens for the employee and employer portion of Medicare and Social Security, as well as federal income tax withholding on behalf of the employee, and that's what's being remitted. So this is a huge area of adjustment, okay? But if you think of it, really materially, what's going to happen is all you need to do is allocate appropriately what are the actual wages and what are the actual taxes. Also, this line would be different because any entity can choose to accrue state income tax expense, and state income tax expense is deductible on the federal level, but not deductible for the state. Okay, so this is the first kink. Now, Megan mentioned she gets diagnostic, right? And we all are going to get diagnostic. Well, why is that? Well, because let's say not really because of amortization or depreciation, and not really because if you think about it, the system is going to already book for you amortization and depreciation, meaning over here, the accumulated depreciation amount is going to get higher. So expense gets debited here, accumulated depreciation gets credited here, and you're going to be in balance, okay? What will totally throw you out of balance is this line item here that says travel and entertainment, okay? Travel and entertainment. There is also statement 9 and statement 10. So all of these little things will throw you guys out of whack, because then it's not the tax return, rather the balance sheet within tax return is not going to balance, because on the books, okay, P&L for the books is going to have 100% of value for entertainment and for the meals. P&L for the per tax return is not going to have, right? It's going to have either 0, and it's going to be a reconciling item that's going to show up here, or the 50% of the meals. So what do we do at that point? Well, the adjustment is going to go towards distributions, okay? It is the money that is deemed distributed or loaned from the company, okay? So what I would do is I would put it towards distributions, okay? So distributions we have over here. So you put the difference towards distributions, okay? If the client wants to create some kind of other line item, maybe you know, within the retained earnings, within this last, pretty much within the bottom of their balance sheet, they can also create an account that says something like permanent book to tax differences, okay? They can book it there, but it is not going to help our case for the tax return, simply because since the difference is permanent, it does need to go either against distributions or retained earnings. I mean, in this case, retained earnings are just off the charts negative, and we have other liabilities. So yeah, this client has loans and lines of credit open and a whole bunch of notes payable, which is, well, not really okay. This is okay. This is pretty high, no matter though. So long story short, whatever permanent differences are, they are going to go to distributions, okay? And if the client questions you, you can tell them that on their internal books, they can create an account within the retained earnings portion, contributions, distributions portion of the balance sheet that will say something along the lines of permanent book to tax differences, but in reality, it always goes to distributions, okay? So this one, Megan, is the one you're going to be adjusting. Once it tells you, for example, here at travel entertainment 44464 per books, you know, for the balance sheet, obviously, it's going to differ. So you may need to adjust for that. Okay.
Can you show the the adjusting entry just so I can make sure I understand, like on the software?
Sure.
Thank you.
So whatever we are adjusting is going to go on Schedule M1. Okay, Schedule M1. For example, what is not deductible on the tax return? You're going to see expenses recorded on books, not included on Schedule K. Schedule K, that is the net that's going to be then shown on the, not only on the tax return, but also distributed to the shareholders. So technically speaking, all it's saying, expenses recorded on books, not included on, literally you can just say tax return, just for the simplicity. First of all, penalties. Penalties are not deductible, okay? So for tax purposes, remember how, let's say we were adding back the depreciation and amortization to get to the actual P&L provided by the client. Well, penalties, they have been we're going to add them back as well because they have been taken on the books but are not going to be taken on the tax return. But that would be to arrive to the actual tax return number. So penalties, 40,121, we're going to input them. Other, let's see what other, non-deductible gift expense, non-deductible penalty fee of sorts, which is penalty fee. I would just lump in with the penalties, but sure. Depreciation not on K. So this is where you actually, this person has adjusted it manually. I would try to not do that because within the software, we do have our depreciation tab. And within depreciation tab, if you click on a detail, there is book depreciation, okay? And cost basis, my apologies, guys, one moment. And instead of adjusting it, or rather overriding it there, I would just make sure that for all the assets that we have in here, okay, for example, Chevy van, cost basis, very low for whatever reason, probably used vehicle that the person bought. So cost basis goes here, and then whatever depreciation was used on the actual P&L, right, if depreciation was provided. Now, so that's depreciation. On the flip side of things, there's other something, IRS refund. Okay, that's fine. Tax exempt income. This is where also PPP, you know, forgiveness would go. Okay, this is also in other. If you see, which is, I don't think there's going to be any more of it because technically everything was forgiven, you know, latest in 2021, but never know. So this is where all loans forgiven that are specifically not taxable. Other loans forgiven are going to be taxable. Okay. Now, once all of these adjustments were made, okay, we always have accumulated adjustments account. It's a little bit similar to retained earnings, but it's going to be different in the manner that it will calculate, or it will take into account these permanent differences, which in P&L, technically speaking, there is not going to be an adjustment, you know, for the 50% of the meals for things that are specific to the tax law per books, they're not going to be there. Okay. Now, give me just 1 second. So, for example, at this point, give me just 1 second. We would go to distributions. So it's shareholder information, shareholder ownership, stock ownership. We would go to distributions and loan repayments. And for example, if there is $4,000 difference, let's say 50% of meals equals $4,000. On the books, you would see that distributions to Leonid Molchanov were 15,970. Here, we would show 19,970 because we do need to adjust for the 4,000 that are not taken on the tax return. Okay, so you would see which way the adjustment goes, whether, and I think it's also in the moment is going to be better. Whenever you guys have, you know, problem with the balance sheet not balancing, just shoot me a quick text in WhatsApp. And I think subjectively, the more of these you do, the more you'll realize what you need to do with the distributions. Do you need to up them or do you need to actually issue less of them? Okay. But technically speaking, this is the number that would be changing. So we're not going to be changing anything within the balance sheet other than the amount of distributions that is caused by either temporary or permanent book to tax differences. Okay, so distributions are the only ones that are going to go up or down. Does that make sense, Megan?
Yeah, that makes a lot of sense. Thank you so much.
Mm-hmm. Yeah, and I always try to make sure what I would suggest when you guys are working on S corps, later on when you're ready to, you know, submit it or issue a draft, you can actually tell the system not to fill out the balance sheet and not to fill out schedules if indeed the person qualifies, which I mean, this would definitely qualify because total assets are less than $250,000. But I would suggest when you're actually writing and or reviewing the tax return, always have Schedule M1 here, so you know why the heck you have net income per books as one thing and how then you arrive to this. This will show you, right, what expenses, or rather what is the difference in expenses that you're showing within the tax return. Oh, my apologies. So that's that. Oh, and of course, apportionment. I wanted to chat with you about apportionment. So it's going to be all the way under state and local. And for example, for California, it's Schedule R. Okay. So this is where you would actually tell it if you want to elect a three-factor formula. For California specifically, it is for agricultural companies, including farming activities, all kinds of, I don't know, breeding, nurseries, and all kinds of other things. What you can elect is automatic apportionment, and you would quite literally fill out the sales factor. Okay, you don't need to fill out anything else, but you do need to fill out sales factor. And it's literally, you would just ask client for a respective P&L by category. Okay, you would tell them that category is the state, and people who actually do business in different states, they do run their P&Ls based on the state as well. They can filter. Problem is with the QuickBooks Online that sometimes they can't filter because QuickBooks Online doesn't provide P&Ls by category, as far as I know. But they usually use the softwares that can separate the receipts out. So it may not be the actual profit and loss that you're getting if the person's using QuickBooks, but whatever platform to invoice they're using, they will then generate from that platform a form for you, okay, to look at that report and see what is the sales factor specifically to California, and then to Georgia, and to Texas, and then blah, 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 blah. Okay, so this is where the apportionment would go within state and local, and of course, handy dandy, you know, lookup thing always takes you there. Okay. All right. Any questions on S Corps, you know, on where what goes, or anything quirky, anything specific?
I don't think so, not right now at least.
No.
All right, so let's do this then. Not to hold Megan up further, and I need to hop on a quick phone call. We're gonna wrap this session up, okay? And then Yana and Beck, I will see you guys in about 10 to 15 minutes for the Q&As that you may have specifically, and then we'll go over a few tax returns with you, okay?
Okay.
Okay,
Thank you.
Thank you so much.
thank you.
Yeah. Talk to you soon. Bye, guys.
Mhm.